Oh hey, I didn't see you there. I was just admiring these rocks I have, and that's exactly what I'm gonna show you today. Exactly how to build an investment portfolio that's rock solid, bulletproof, impenetrable, ironclad, basically just a really strong foundational portfolio for 2022. With 2021 coming to an end and the stock market on a seemingly crazy run the past 2 years or so, a common theme that I get in my Patreon and in my comments is that people think that it's too late to invest. They also question whether or not they should start investing now with the stock market being, quote, so high. My opinion is that while we don't know what's gonna happen in 2022, if you're into long-term investing, it's still a great time to build a portfolio starting today. If you've seen other finance YouTube videos or just talked to anyone interested in investing, you may have heard that age-old adage, time in the market beats timing the market, and that's actually been proven out with multiple studies. So if you're a new investor or a seasoned one and you're looking to build a conservative long-term investment portfolio that builds your wealth over time, yet still captures some upside, then in this video, we're going to do exactly that. So first off, if you're someone who just wants to sit back and relax and not have to worry too much about the daily swings of the market, what you can actually just do is buy an ETF that tracks a major index like the S&P 500. That's a pretty good strategy for the investor looking to capture the returns of the market, and a passively managed ETF like VOO has been proven to be a good choice over time. For example, in 2021 alone, it's returned about 15% year to date. And in the past 5 years, it's returned around 17.6%. But considering you don't have to do anything with an ETF, you can just invest your money and forget it, getting a return as good as 8 to 15% is going to be a solid option for most investors out there that might not want to be active investors. Now, that ETF strategy is pretty good for a beginner or an advanced investor who just might want to prioritize their time elsewhere, like in their career instead. For this video though, I want to go into the allocation that I personally use that allows me to invest for the long term, capture a lot of upside, yet I still feel pretty safe by the holdings that I do hold. So I'll bring up on the screen my exact allocation and we'll talk through each of them. So the first, with the least risky, is going to be cash. Now, my ideal target is to have 10% cash in my portfolio because I believe that, okay, my cash is safe here, and it's also liquid in case I see great opportunities to buy in the stock market. I also like having cash in the portfolio overall because then that means I hopefully won't be dipping into my cash savings in my normal checking or savings account in case I see an opportunity. In a way, it's kind of mentally limiting myself to ensure that I'm only investing with the money that I've set aside for the purpose of investing. Some people like to have more cash, 15% in their portfolio, and some people like to have none at all, but for my portfolio, I like to have a little bit of cash, and that really helps me with a little bit of peace of mind as well. Before we move on to the investments, the overall investment strategy of this portfolio, I would say, is to be aggressive in the right spots, but conservative with everything else. The majority of the portfolio will still be in conservative holdings since this is still a very long-term minded portfolio. It's not really a portfolio for day trading, so if you are looking for that, then this video is not the place to be. All right, so the next chunk of my investments will be in ETFs. These are the foundation of my portfolio, and my philosophy is to basically keep a large chunk of my portfolio in ETFs because these are just gonna plug and chug at an average rate of return of around 8% a year in the long term. An ETF is basically one security, and by buying that one security, you're splitting up your investment among all the pieces that the ETF invests into. So with an ETF like VOO, for example, as we mentioned earlier, by putting, let's say $1,000 into VOO, your $1,000 investment is split among the 511 stocks that it holds. Other ETFs you can invest in are ones like VTI, which is the total US stock market, or even sector-specific ETFs like an energy ETF or a real estate ETF. For my ETF allocation of this portfolio, I like having 25% of my overall portfolio in ETFs. So if my portfolio was $10,000, I would allocate $2,500 of that into different types of ETFs, or just one ETF. So ETFs are gonna be one part of my foundation. The next allocation I wanna put my money into are blue chip stocks. These are your Googles, your IBMs, your Johnson & Johnsons, your Apples, your Amazons of the world. They are super large capitalization stocks that are going to remain stable over a long period of time. Think of long-term businesses that should still be around in like 20 to 40 years. A blue chip stock usually has an excellent reputation, might even pay a dividend, and they have dependable earnings and are profitable. If you're looking for a filter from a market cap standpoint, I'd be sticking to stocks that have a market cap of around $100 billion. That means that their valuation is at least $100 billion, so that definitely doesn't mean penny stocks and definitely not stocks that are brand new with no earnings. For example, Rivian Automotive has a market cap of around $90 billion, but they haven't even produced any earnings yet. Be careful of just the market cap number and just make sure to use common sense here. To give you guys some examples of some companies around the $100 billion mark that are pretty, rock solid, they include American Express at $120 billion market cap, CVS at $120 billion, Target at $118, and HSBC at $115 billion. You can even go higher on the list. So looking at the top 10, Apple, Microsoft, Google, Amazon, Facebook, or Meta, or something like Home Depot or Samsung, these are going to be companies that are still going to anchor your portfolio, yet they're still going to capture more upside than just a normal ETF that tracks the market. Apple, for example, has been killing it this year, up around 25% this year alone, and Home Depot is up 54%, just to give you an example. So definitely look into these companies and make sure that they're profitable, they have healthy balance sheets, and their management teams are good. If you really want to figure out how to do that, I might make some videos on fundamental analysis of different companies and how I pick stocks, so make sure to subscribe to the channel for that, and also join 325,000 like-minded subscribers of the same channel. All right, so for the blue chip allocation, I put 35% of my overall portfolio into blue chip stocks. So if my portfolio size was again $10,000, that would mean I'm putting around $3,500 of my portfolio into blue chips. So as you can see, as of right now, we've allocated 35% into blue chips, 25% into ETFs for a total of 60% into blue chips and ETF stocks. And we also have 10% in cash for a total of 70% of our portfolio being in relatively safe and stable investments for the long term. That's going to leave us 30% for our portfolio to play around with and try for bigger upside plays that can hopefully produce outsized returns for our portfolio in the long run. But the great thing here is at least our foundation is set. That's what we really care about. We know that as long as we hold these with a long-term vision, we're most likely going to be pretty safe and preserve our capital. Before we move on to the next portion of the portfolio, just know that even though I'm describing my portfolio as safe and stable, it's still not immune to swings in the stock market, so you always have to consider that there is going to be some risk when you're investing. So the next chunk of asset allocation is going to be in growth stocks. 25% of my allocation will be in growth stocks. A growth stock is a stock that's expected to outperform the market, but they're also going to have more downside during a market pullback. Growth stocks typically have characteristics like they don't have proven revenue, or they have a new product that's supposed to be a differentiator, or they're just plain too new, or a combination of all the above. For example, Amazon used to be a growth stock at the time everyone was selling stuff in brick and mortar stores. Books were mostly sold in person, and Amazon disrupted the entire e-commerce and book space. Now that it's a really big company, it's more classified as a blue chip, but during that period of growth and innovation in the 2000s and 2010s, you could have classified Amazon as a growth stock. Their returns definitely reflect that, as from 2011 to 2021, their stock has appreciated well over 1,588%. Now, in contrast, the S&P index has earned a return of 287.5% since 2011. So basically, Amazon outperformed the market by 5.5 times in the decade prior. Most growth companies have a lot of inherent risk because of how unproven they are. So I'm going to share with you guys one of my growth companies in my portfolio today, which is Palantir. If you'd like to see everything I invest in, that'll be in my Patreon with the link down below. But with Palantir, it's been constantly trading around the high teens or low 20s. It's definitely underperformed the market, and if you bought it back in January at its all-time high of $35 per share, you would be down close to 50% on your investment. So why did I invest in it, and why do I continue to hold it in my portfolio, for example? Well, the methodology that I use for picking growth stocks can be boiled down to a combination of the following. First, you should understand the company and exactly what it does. Second, you try to get an understanding of their financials and their path to profitability or even increased profitability. In Palantir's case, they ended their recent quarter with $2.3 billion on the balance sheet and no debt, so I know that the company isn't exactly going bankrupt. Third, I like to gauge if their product is needed or if there's demand for their product. So in Palantir's case, over half of their revenues come from the US government. Palantir has a data visualization tool for understanding large data sets, and I know that government contracts are usually long and entwined, so once the US government becomes your customer, I doubt they're going to be switching providers for analytics that quickly. So I know that it's a company that in the long run should appreciate over time if all goes well and if they can continue to add external customers besides the government. So just because I own Palantir doesn't mean that you should go and blindly buy it. Make sure you do your own research and come up with your own ideas and different theses around different stocks before adding them to your portfolio. Of the 25% chunk of your portfolio that's in growth stocks, feel free to go all in on one conviction or split that 25% allocation up into a few different companies or as many companies as you see fit. Just remember, the growth stock portion of your portfolio is for higher risk plays, so you have to be okay with stomaching some volatility volatility when it comes to this section of your portfolio. All right, so that leaves 5% left. With this, the 5% can be pretty flexible. If you need more cash, feel free to add it to the cash pile, or feel free to add it to the growth or the blue chip pile. But for me, I like to put between 5 to 10% of my total portfolio in crypto as well. It's just an increased magnifier of risk, but the potential upside is also greater. I've personally set aside 5% for this particular sample portfolio for cryptocurrency. You guys will notice that I didn't include any bonds. So right now, bonds are pretty weak in terms of return, and they just don't provide enough upside for the portfolio I'm trying to put together. Again, if you are older or close to retirement, you may want to take some percentage of each bucket and allocate them toward safer fixed income products like bonds. All right, so now I'm going to bring you into my computer for what the portfolio looks like in a Google Sheet, and we can actually talk about the different number of holdings. So as you can see right here, this is a sample portfolio of $10,000, and each section is divided into their types. So we have ETFs, growth, blue chip, crypto, and cash. So I've personally just chosen one ETF here, which is ticker symbol VOO, which tracks the S&P 500, but you can choose up to 2 or 3. And if you want more ETF suggestions, by the way, please watch the other videos that I have on this channel. There's 5 growth stocks in this portfolio, including Tesla, Shopify, Square, Palantir, and Airbnb. Honestly, you can get away with a lot less, or you can add more holdings altogether. For the blue chips, as you can see here, I have some spread across different sectors. So I have Home Depot for consumer, Target for consumer, Bank of America and American Express are actually financial companies. And then we have Apple and Google down here, which are tech stocks as well. Now for the dollar amounts for the different stocks, you can see that in the growth stocks, I've just kind of split it up evenly across the board. For the ETF, since I only had one, I put the entire 25% into that one ETF. But this is kind of up to you. You just kind of want to figure out how much you want to put into each one. But as long as the total sector or the total basically type, so blue chip, growth, ETF, or crypto, amounts to the percentages we were talking about in the video, then you should be pretty good. As you can see from this table, this exact portfolio has 25% in ETFs, 25% in growth, as we talked about, and so on and so forth. So I would say when you're forming your portfolio for 2022, it's good to write it down before you start buying. That way you can go in with a plan or even average into some of these positions. So anyways, I'm going to scroll right back up to the top right here, and you guys can take a screenshot of this. Feel free to pause the video, make sure to subscribe, and also check out all my resources in the description below. And I will see you guys in the next video, which will hopefully be in a few days here. All right, peace.